US stocks fall and US Treasury yields rise after US growth and inflation data was worse than expected. Australia's strong CPI could shift the RBA's rate cut track. Indonesia hikes rates to bolster its currency, and South Korea's GDP beat forecasts. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, looks at what central banks across Asia face in terms of monetary policy for their currencies if the US Federal Reserve delays rate cuts.
A weaker currency, particularly for most of Asia who are energy importers, it also means you're adding to inflation. So currency stability does have its merits.
But first, in 5 and 5 with ANZ, US stocks were down between 0.5% and 1.2% at 5 a.m. Sydney-Melbourne time after US growth data was weaker than expected, but more importantly, inflation data within that was hotter than expected. US Treasury yields rose 6 or 7 basis points. The 2-year rose to 5%. That was after the US GDP price index rose to 3.1% on an annualized basis from 1.6%. That was higher than the market expected. ANZ head of G3 Economics, Brian Martin, says the number wasn't too surprising, and the Fed prefers using the PCE inflation measure, which isn't due until later tonight.
But the market did focus on it, certainly prioritised the pickup in inflation over the weakening in GDP growth, and as a consequence, expectations for when the Fed will first cut interest rates repriced back to December from September, just before the data were published.
The US dollar fell about 0.2%, which saw the Aussie and Kiwi dollars up around 0.2% by 5 a.m, with the Aussie at 65.12 US cents and the Kiwi at 59.44 US cents. Number 2, Australia's annual CPI was slightly stronger than expected at 3.6% in the March quarter. That was down from 4.1% in December. The trimmed mean measure at 4% was also higher than forecast. ANZ senior economist Catherine Birch says the RBA will want to see non-tradables and services inflation slow considerably in the June quarter to keep confidence that it can start cutting in November.
Our base case for the start of the RBA easing cycle remains November, but the Q1 CPI data for Australia suggests that the risks have skewed towards a later start. Both headline and trimmed mean CPI inflation appear to have printed around 0.2 percentage points above the RBA's forecast. Now, you add that to the stronger than expected labour market data since the RBA's March meeting, and it does suggest that the risk of a later start to rate cuts have risen.
Number 3, South Korea's March quarter GDP was surprisingly strong. Quarterly growth of 1.3% beat all forecasts and contributed to an annual rate of 3.4%. ANZ economist Crystal Tan says the growth was broad-based, led by exports and construction.
It will be challenging for domestic demand to sustain its current momentum given high interest rates, a weak real estate market, and also highly leveraged households. For now, though, with growth tracking above its projections, the Bank of Korea will continue to prioritize getting inflation back to its 2% target. We expect it will still retain an easing bias, but the balance of risk is shifting towards just a single rate cut this year, as opposed to our baseline for 2.
Number 4, Malaysia's CPI inflation rate was 1.8% in the year to March, the same as in February, and below the consensus forecast for a 2% rise. Here's Crystal again.
The breakdown showed a pickup in services inflation following the increase in the sales and services tax. However, this was offset by a pullback in food inflation. The big picture is that price pressures in Malaysia remain benign and are not going to shift the dial in terms of monetary policy.
Number 5. Indonesia has become the first victim of growing expectations that the US Federal Reserve will hold interest rates higher for longer. Bank Indonesia has hiked its key policy rate by 25 basis points to 6.25% after renewed currency pressure following recent strengthening in the US dollar.
Bank Indonesia wanted to signal a stronger policy response to strengthen rupiah stability. Now, its hawkish pivot came on the back of a shift in its expectations for the Fed funds rate. It now expects the US Fed to deliver just one cut this year, likely in December. There were no changes to its domestic macro projections. So Bank Indonesia's policy rate trajectory is going to continue to be driven by external rather than domestic considerations. We cannot rule out further hikes, given still elevated external uncertainties.
Crystal tan there. That hike by Indonesia's central bank now has traders asking what other central banks in Asia will do. In today's bonus deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, looks at what central banks in India, the Philippines, South Korea and Thailand are facing.
The question for us is, well, what if the Fed doesn't cut? And what then happens? Which central banks in the region are able to cut? Now, we really could come up with two central banks, that's South Korea and Thailand, that have the ability and the need to cut interest rates, whereas India sort of falls in between. It can cut rates, but it doesn't really have a pressing need to do so. By contrast, the Philippines and Indonesia have no flexibility. This is based on a couple of considerations: how durable the improvement or the lack of it is in the balance of payments, how far are you away from the inflation targets, and how overbearing is the level of debt in any economy that forces you to make a change or cut interest rates.
To step back a bit, for those people who see the currencies in those areas as freely floating, just asking the sort of a basic question, why can't they run their monetary policy independently of their Fed?
Well, I guess the biggest pressure really comes around on the currencies. Now, as such, it's easy to say, well, what's wrong with a weaker currency? There are two issues with it. One, it becomes very volatile. So exporters, importers really cannot price their goods. Second, if it stays on and lingers on for a long period of time, it does risk some sort of financial instability, people taking their money out of the country, etc., and those sort of issues emerge. And thirdly, a weaker currency, particularly for most of Asia who are energy importers, it also means you're adding to inflation. So currency stability does have its merits.
Just looking at those two countries, South Korea and Thailand, that do have some flexibility there, why is it they're in a better position?
I think if you look at Thailand, and both the countries have different characteristics. One, they do have a high level of debt. Second, the current account is improving quite rapidly. In the case of Thailand, tourism receipts, etc., are picking up, and that helps the current account. Thirdly, Thailand is actually suffering from very low inflation, quite in contrast to perhaps the rest of the world also. South Korea, inflation is still a bit of a problem. It's been quite sticky. But nonetheless, what has happened is, again, the current account is improving rapidly because of the turnaround in the global semiconductor cycle. And Korea is amazingly well tuned into this upturn. The third is that Korea, like Thailand, does suffer from very high levels of household debt, and they would find it increasingly difficult to service or, complete their debt service properly should interest rates remain on the high side. So both these economies have the ability and the need to cut rates.
Sanjay Mathur there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, April the 26th. Catch you next week with a deep dive into why Australian consumer confidence has been so low for so long and what that could mean for the RBA. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.